Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments and subscribers, I greatly appreciate it. This week up, Intel. Let's go through Intel, the behemoth, the giant, the leading industry leader in the semiconductor business. Let's take a look at their financials through their 10K that they just filed December 31st, 2020. We're going to take a look at this number. We're going to take a look at 9 years of history. We're going to take a look at the review I did last year at the same stock, and we're going to try to forecast this business and see what we can get by earning the stock over a decade. Ready? Let's get to work. So before we dive into Intel, I want to review the 5 key attributes that we look at for all of our investing. Number 1, top line revenue growth. You got to have it. Number 2, EBITDA growth is enterprise level earnings must be growing. Strong free cash flow. We want to see low debt, and we want to see a well-priced stock, well-priced being enterprise value to EBITDA. We will also consider free cash flow yield as well. There are 2 relative price metrics that we use to gauge if a stock is cheap or expensive. Remember, we don't necessarily have to buy it when it's dirt cheap. We just don't want to overpay for growth. Again, check out my Domino's versus Google IPO video where I demonstrate this purpose. Both Domino's and Google IPO'd the same year 15 years ago. Domino's IPO'd cheaply, struggled at some point, continued to grow. Google IPO'd with great fanfare and was a rocket ship. In the end of the 15-year time frame, Domino's outperformed Google on an IRR basis because it paid a dividend, it bought back shares, and it IPO'd cheaply when you could buy it. Google still grew, still performed, but you paid so much for it at the IPO that ultimately Domino's was able to outperform. Very interesting video, check it out. Back to Intel. So we're going to go through our 5 key attributes. We're going to take a look at this. We're also going to review what I did last year. Couple updates on Intel. They've since changed CEOs. Old CEO is out. He could not grow the business. The new, it's not exactly true, but I think they needed a change of pace with their manufacturing setup because it just wasn't moving fast enough with the times. But so he is out, new CEO in. New CEO is saying he sees a long-term growth prospects and strong business dynamics for the business. Really, really interesting. And they printed a great year. Let's take a look. Okay, let's take a look at Intel's revenue. $53 billion in 2012, and that has grown to $77.8 billion over this 9-year period of time. And it seemed like this period here was a little flat, but it picked up recently very strongly with the stay-at-home trade that we've seen as a result of COVID. Recently minted $77.8 billion of top-line revenue growth, which is strong year-over-year growth. EBITDA always positive, always seems to be going generally up, a little flat in this period, but recently printing $36 billion of top-line revenue growth and 8.6% year-over-year move. When I look at average growth rates over this period of time, right, these are CAGRs, they're compound annual growth rates. So this 4.8, almost 5% on the revenue, 6% on the earnings. So we've got a little margin expansion over time as they scale. Both numbers positive every year. No huge swings either up or down. So I think that's pretty easy to forecast going forward. We're actually going to check out the forecast I did last year for EBITDA. Oh, let's do it right now. Why not? It's Intel, wrong button. Here we go. So this was my forecast last year, $34.5 billion for 2020 EBITDA. What they actually minted was $36 billion. So I was conservative on the number. I didn't obviously see COVID coming. This was early last year when I did it. So they jumped into that. That's a huge number for them. Congratulations, team, for printing a great number. From what I hear from the new CEO that's out there, he is saying that he expects a long-term growth prospects for Intel to be bright, that this demand for semiconductors, their positioning in the market, the expansion of all of the 5G network across the Internet of Things is going to allow them to supply product into those markets for many years. So I think they can continue to mint a low single-digit EBITDA growth is a very realistic target for such a big company as Intel is. Let's take a look at the rest of the capital stack and see where enterprise stacks up. Debt, they do have some debt, $13 billion to $34 billion, kind of growing a little bit in line with kind of the growth of the EBITDA. Nothing too shocking about that. They do have some excess cash which is on the balance sheet. That's nice to see. Market cap is a monster, man. $100 billion company to $200 billion company. It's a big, big, big company. I'm surprised that they added $100 billion here. Not a whole lot of growth over this period of time. When I add the debt plus the market cap less excess cash, I get enterprise value. Enterprise value is the, not even R, it's the value of Intel, including all of their debt and everything. And it went from $112 billion to $241 billion. It's currently at about $273 billion of enterprise value. Market multiple for this business is a kind of mid to high single digit number. You've got a 5x on the low end, kind of a 9x on the high end. Again, these businesses trade at kind of high single digit EBITDA multiples because they have to put some cash flow back into CapEx, which EBITDA doesn't really capture. So EBITDA is lower to compensate us for the fact that you have to reinvest in the business. Net debt is our metric. Net debt to EBITDA is our metric for kind of a risk of bankruptcy, right? If the business were to struggle on cash flow and go into bankruptcy, that's a court filing. The judge is going to look at everything, that all the pieces of debt and obligations that they've signed, and he or she is going to just pay down the capital stack from the most secured creditor to the least secured creditor. The most secure creditor are employees. They get their first money to make sure that the paycheck's clear. That's the very first obligation. Then it's kind of vendors that have supplied services. Then it's your bondholders, senior, junior, mezz. Then you get your preferred equity, and finally us, the equity holders. So you always want to make sure that this number is as low as possible. If it's zero, which is really close, this is less than one term, but if it's zero, then that means that you, the equity holder, are standing right behind the employees and the vendors as a collateral position on the stock. And this is very low. So when I look at the current debt that's out there in the public market, all the zombie companies that can't actually make earnings because all their earnings are going to pay interest, this does not seem like that company, which is nice to see. And that's a company I want to own to safeguard my money. My principle is I work for it. I'm putting it away. I don't want to just gamble it away. I want to put it with an enterprise that is stable, that is growing, that has low debt, so they're not risking my money. And that, to me, is kind of like owning a bond. Certainly, if there's no debt in front of me. So what's the picture here? You've got revenue growth, EBITDA growth, low debt, well-priced. Yeah, it's not too expensive. It's 7.5 times future earnings. It's not 10, it's not 12. It's in range of where it's been in the past. So I think here, for me, this is checking a lot of boxes. Let's go take a look at free cash flow. Okay, free cash flow, my favorite statement, your favorite statement. We're going to pick that up with the free cash flow from operations line, the first third of the cash flow statement, $18.8 billion of free cash flow to $35.3 billion of operating cash flow. Strong numbers, kind of flat in here. I think that's what got the old CEO tossed out, right? He was a legend in the industry, so he lasted a long, long time. But I'm optimistic that the new management team is going to try to accelerate growth a little bit and really push that needle, which is what this company sorely needs. CapEx, remember, they are foundries. These are large manufacturing facilities, so they have to put in a lot of money that they generate back into the business. This is the money that they generate from selling all their chips. What they have to do is they have to peel off large dollars amount that, put that back into the infrastructure to keep that wheel running. Also make modifications for new products that they need to make coming up forward. So all of that is in here, and you can see the spread here is about 50%. So they're putting a lot in, but they still make a lot of cash. So what I like about this business is, despite the fact that they have to invest in that moat of infrastructure for the foundry, but there's still a lot left over. In this year, back in the day, there was $8 billion left over. This most recent year, which was profitable, that is mental math, $10 billion of excess cash above and beyond what they've already reinvested in the business. That's a great sign. And then you look at the debt payments. Well, they don't have much debt, so really this is almost nothing. They borrowed some here because they're going to make massive investments in the future, which is good for them. They have the room to borrow because they have very little debt, so they're flexible to be able to adapt with the dynamics of the industry. So I'm fine with that borrowing. Free cash flow to equity, that's the money that we as equity owners have a right on. And these are all positive, which is great to see. They're all pretty big numbers too. There's no like single digits here. They're all in billions, which is fantastic to see for such a massive company that can create so much free cash flow. I like that a lot. Shares outstanding are declining. Again, what we look for is kind of like a trifecta, if you will, of three things that you want to see. You want to see a company that can grow its earnings, even if that earnings is single digits. You want to see growing earnings. You want to see share buyback. That's what this is. That's over the long term. They are buying back their shares so that without having to put another dime from you into the business, your ownership is slowly growing as a percentage of the business because they're buying back shares and they're canceling them. So where they had almost 5 billion shares before, now they got almost 4 billion shares. That's a billion of shares that were just gone. So if you owned a share here, you have 1 billionth less shares out there. Your value has gone up without having to do anything, even if they don't grow earnings. So you want to see earnings growth, you want to see share buyback, and you want to see market multiple expansion. That last piece is kind of tricky. It's hard, but it's basically buying a company when this market multiple is here and not here. So that means every dollar of free cash flow in this example got 9 turns of value, trades at 9 times versus 5 times. If you hit those three, growing earnings, share buyback, and market multiple expansion, that is a trifecta in my book. That's what I like to call it. And that's kind of your home run stock. Take a look at Domino's. That's exactly how they did it. They bought back stock, they grew earnings low single digits, and they had a market multiple expansion going from kind of an unloved stock to now COVID home delivery pizza, absolute explosion. That's how that's done. Anyways, back to free cash flow. So shares, free cash flow per share. Look how strong these numbers are. Large single digits. We looked at what Micron Technology last week. Micron was 60 cents or so per free share. These are large single digits. 634 is really, really big. And then the price is $50. That is a 12 to 13% free cash flow yield. It's a monster number. We don't see many double-digit free cash flow yielding stocks on this channel. Certainly in this market, they're very rare. Now, that obviously has the debt that they borrowed here. Now they have very little debt outstanding, so they can borrow. I'm not necessarily going to punish them that because they have the room to borrow. That's fine. But if I want to look at what this free cash flow number is without this, right? Take the 5.7 out of here, call that like 21 billion. Divide that by these shares, divide that by the price, and what I get a 10% yield. So even if I normalize for the fact that I shouldn't count the debt because you can't borrow every single year. But if I take cash flow from operations, less CapEx, divide by shares outstanding, I get a cash flow per share. Divide that by the price, I get a yield. That yield is 10%. That's a double-digit yield. Great job. Now, again, that's at the end of last fiscal year when it was about $50 a share. It's a little higher than that right now. So now that same yield is trading at 9%. So a little off, but still a nice yield in a market where treasuries are yielding 1.2%. If I can get a business that has very little debt in front of me, that my stock is protected almost like a bondholder. It's not exactly, but the analogy will float. And I'm having a free cash flow yield on a business that's 9% when the bond market's printing 1.2%. I like that a lot. That is a great kind of bellwether for me in a portfolio. I like that. So I think this checks our free cash flow box. Let's forecast this business and see what we're going to make. So here we go as our forecast. And again, we're being conservative. I'm taking the average growth rate that they have on the line. I'm not bringing it down like I normally do because this is a mid-single digit number. I think they could easily knock that out over time. This is not a 20% year-over-year growth, not 25%. It's 6%. Very reasonable number they could do. Last year, I think I had 5%. So I've given it up a little bit. We were a little conservative, a little higher this year. $38 billion to $66.5 billion at a 7.5 handle. Again, I'm not expanding the multiple. I'm just keeping it about where it is now. A mid-single digit number, 7.5. That gives me just shy of a $500 billion market cap, $497 billion. I subtract what little debt they have, add some cash, I get market cap, $453 billion, divide by the shares they have outstanding, and I get a $107 price target out 10 years for Intel. If I do the same thing on free cash flow, again, pulling the free cash flow number that they have, growing it at 6%, stringing it out, and attaching a free cash flow yield to it of 7.5%. Again, that yield is based on their current kind of 8.5 with removal of some of these higher end ones to bring it down a little bit, because I thought that high is kind of too unusual. So I normalize a little bit, and I get a long-term price target of $156 per share. Okay, now we have two price targets for Intel: free cash flow yield, market multiple yield. Let's go take a look at the two. Current price, $57 per share. I look at these two stocks, I split the difference, and I get $132 out a decade for Intel. I can buy that stock right now at $57. If I put that into our IRR, I get a very, very robust IRR number, 24%. Now, we do not see very many upper 20s stock returns in this channel. This is largely based on this strong free cash flow that they're minting. Now, a word to the wise. This model assumes this is dividend because that's simplicity. In reality, they can dividend a portion of it, which they do pay a dividend. They can buy back shares with this money, which they have been doing. I do not forecast share buyback. All I do is assume that all of this money is dividended out. In reality, they will buy back some shares, but what does that mean? That means that the share count that I use, which is their current, will be fewer. If the share count is fewer, the enterprise value doesn't change, but that means that the share price is going to be higher. So the IRR will be the same because it's either represented as future price being higher or it's dividend out in free cash flow. It's just the semantics of the math. For simplicity, I dividend out. And what you get is a 24% annual cash on cash return on IRR, or almost 4 times your money. A very, very strong return for a very good company that's yielding a solid double-digit free cash flow yield with low debt, low multiple, solid market dominance. It's a great company, in my opinion. I think it's unloved. It's unloved in the market. It's due for a much more respect that it deserves, and it is a good rating on my book. That's the best rating I give a stock. I own some Intel, so it's definitely in my portfolio. I owned it last year. And I'm happy to see, even though the stock price itself hasn't moved that much, I am happy that they grew earnings as much as they did 8%. So in my book, that's fantastic. I got a yield on my stock. I was protected against a collapse in the market because the enterprise, the market multiple is low and has low debt, so low risk of bankruptcy, but they grew their earnings 8%. I'll take that all day long. All right, so I think that's fantastic. My forecast had 5% in growth. They grew it by 8%. So I'm ahead in my book. Even if it's not represented in price, I believe it will long term. That's this name of the game, is rational investing. So let's recap our 5 key attributes. Top line revenue growth, yes, it's there. Earnings growth, yes, it's growing EBITDA. Strong free cash flow, yeah, absolutely, it's strong free cash flow. Low debt, you better believe it. Well priced, yes, I think it's still well priced at a mid-single digit IRR and a almost 10% free cash flow yield. That is a great price in my book. I would sign up for Intel. I'm giving it a good rating. This is Cameron Stewart from Rational Investing. Thank you very much for the time. If you like seeing what I do here, if you'd like to learn how to do this for yourself, to do your own portfolio, I highly, highly suggest you do that. Get a basket of stocks, not that many, 15, 20, maybe whatever you can process on an annual basis by reading the 10Ks. Take my investing course, cashflowinvestingpro.com. I will give you this template. I'll walk through the valuation of Apple. I'll show you how to read a 10K, how to pull the data out, how to populate this spreadsheet, how to forecast, and how to look at this IRR number in context of a risk-adjusted return. What does your growth prospects look like? What does the forecast look like? Right? In this case, single-digit forecast, very consistent to history. I believe they can do that, and yet it produces a very high IRR with a market that would return 10% on average for the S&P 500 for any decade in its history. That's the S&P. So this is 2.5 times. It's 150%. The market return is the forecast. That's very strong. So I can teach you to check out the website only if you want to, obviously. This is my opinion. Thank you very much for watching. I love the comments and the communication. Let me know what other stocks you want to see. Thank you very much. Take care. Bye-bye.